be challenging for the trust recently, as we've really seen all through this year, and a lot of that has been driven by the macroeconomic environment. Actually, we've seen a huge amount of headwinds really for companies, and a variety and volatility of those has not helped market conditions. I think if we look back to the more recent months, actually, what we would say is there feels like there is more of a rationality in markets. And by that, I mean, companies who are performing well and getting earnings upgrades, their shares are broadly being rewarded for that. But similarly, companies who are struggling and seeing earnings downgrades, are continuing to be punished. And I think that's a bit different to the very start of this calendar year. We would have said actually we saw more irrationality in markets, as we saw much more of a value versus growth dynamic. Things have got a little better lately, and what I would say from that is that we are starting to see quality factors just over the past month or so be more meaningful for markets. And I think as we really are just at the start of a recessionary period, that is something that we do think will become of increasing value to shareholders and the market as they look for companies who are more resilient and who can withstand some of these variety of macro headwinds that they're seeing. So one thing we have been doing with the trust of late is we have been reducing the net gearing a bit. So we have repaid some debt and we have cash levels quite high at the moment. I think we are continuing to see that the market conditions could be challenging for a number of months still, and that's really driven some of that decision. But I think one of the benefits that we always have with the trust is we do have the ability, to gear back again. So when we do feel more confident about market recoveries and about performance, there is that optionality. And I think that's one of the great advantages of investment trusts to shareholders. I think apart from that, really, a lot of it's been around standard portfolio construction activity for us. So continuing to weight the portfolio towards companies who are doing well in this environment and thriving. And we do continue to have some new ideas being added to the portfolio as well. So even despite all the headwinds and volatility around, there are companies where we actually see increased and new opportunities, and particularly given some of the valuations we're now on. So recently we've added a few new holdings to the trust, and those include Serica Energy, Smart Metering Systems, and Paragon Banking. So if I talk through those briefly, Serica is a North Sea gas producer. And I think, in terms of the relative strength of that region and the governance aspects, we do feel reasonably comfortable with the North Sea. And what we like about Serica is that it has a really strong balance sheet. So high net cash on the balance sheet, and increasing as well given the strong cash generation. They also are led by a real oil-based management team, oil and gas in terms of their experience. And, some of these oil and gas companies we do often see are really run by, finance individuals. So we do like that these are real industry resources management. And we do like as well that they have a good track record of acquiring and improving assets in terms of production. So, while gas prices will definitely be an impact for them, and they will be volatile, we suspect, when we look at forecasts, we actually thought that the gas price forecasts were reasonably conservative. And importantly, there are structural aspects in terms of the lack of storage ability we have in the UK, which we do think will support gas prices. We also added a position in Smart Metering Systems. This is a business we actually held a number of years ago, but we've been out of the stock for quite some time. And one of the things that we like about this business at the moment is the visibility it provides. So through its smart meter businesses, which are domestic focused, what you get is you get very long-term cash flows, visible and importantly, inflation linked. You've got an already invested base of assets, which are now throwing off sustainable cash flows. And on top of that, we also have the new battery grid storage part of the business. And this will really be the growth engine, which has quite a similar business model. And the last new holding is Paragon Banking. So also a company that we have held in the past. And I think one of the things that's really important about Paragon is how it's changed from the global financial crisis. So what we've seen with Paragon before, and this is a buy-to-let mortgage lender primarily, is that actually the credit quality has held up very well. And we saw that through the global financial crisis. But what's really improved about the business now is that it does have a banking license. And so how it funds itself really is predominantly through retail deposits. And that really provides security, we think. In the global financial crisis, the real challenge for the business was when the securitization market fell apart. and it doesn't have the same exposures now. And it really does have the ability to turn on the tap if they do want to increase funding through just adjusting the retail deposit rates. We've exited a couple of holdings as well, so I would mention Jet2 and Hotel Chocolat. So Jet2, we absolutely still believe is a leader in its space, and I think it will come out of this period with better market shares than it had previously, and it is continuing to invest. But one of the things that we struggle with is really just the consumer environment, and particularly looking into 2023, we think that is going to be challenged in terms of the affordability of holidays for consumers across the UK. And that's also going to come at a time where airlines such as Jet2 look to have to increase their pricing as their hedges they have on fuel are rolling off, and the higher prices and costs of those inputs are really going to start to impact next year. And Hotel Chocolat is a holding we've held for a number of years. We've really been investors in that since IPO. But one of the challenges we see for them at the moment is that we have got a change in the investment case. So the management team, although trading had actually continued to be strong in the UK, looked forward to their outlook for later in the year and really saw that the consumer environment in the UK was probably going to challenge that, and particularly at a seasonally heavy time for them later in the year. So that reduced those UK revenue growth expectations. But along with that, we also have seen them step back from their international expansion. So stepping back from the US, and also in a way in the JV in Japan, where they've continued to have, unfortunately, COVID impacted periods, which have led them to decide to not allocate any more capital to that JV. So really we see a big change in terms of those growth potentials internationally. And that's come at the same time as the business has been investing in capacity for manufacturing and distribution in the UK, which unfortunately all combined created quite hefty earnings downgrades. So one holding that we have in the portfolio is 4imprint, and this is a promotional products business which is really focused on the US market. Now, 4imprint had a tough time during the COVID period because a lot of their activity is often based on person-to-person contact, and we've seen that improving coming out of COVID as the business and the market recovers. But we felt there was much more to the investment case than that, and this is a business that has really thrived in the years prior to COVID. So when we looked at the forecasts and we discussed with management team, we really had a high conviction that this wasn't just a COVID recovery play, but that this was really sustainable growth going forward. And also that they were managing many of the logistics aspects that have been challenging very, very well. And one of the key things that we've seen since then is we have seen strong update reporting from the business, we've seen continued earnings upgrades, and importantly, we've seen that rationality I talked about where the shares have done particularly well on the back of that. And one of the things we really like about the investment case is actually the marketing investment that they've made. So this is an incredibly fragmented market space. In the US, they probably have about 3% market share, and that actually makes them the biggest. So it's very fragmented and really good opportunity to gain market share. And one of the ways that they were achieving that prior to COVID and has really come back again is their investment in marketing. And a lot of this has been sort of TV and radio marketing in the US. And what we see on the back of that is a really high return on investment, whereby they're not only gaining customers, but these have been proven now to be sticky and repeat business, which really gives more conviction to them in terms of continuing to invest in marketing and gain market share. Another holding in the portfolio, which I think is really interesting, is Big Technologies. This is a founder-run business with really global exposure. And what it focuses on is really electronic monitoring, which is predominantly for offenders and to keep people out of jail. So what we see for them is we see a range of contracts globally, and this really provides some diversification. And these contracts are of varied length in time, but what's important is we have a really strong view that actually these contracts will continue to be renewed as well. Forecasts also assume no new contracts are won, and we feel confident that the pipeline is really strong and they will continue to execute on that. The advantages of these tagging, well, for the Departments of Justice and Defence who utilise these sort of tags, what we find is that actually they have a really high return on investment for those as well, because these are very easy to implement, they have lower servicing costs, and importantly, they have lower false alarms. So they really do get a benefit. And also for the wearers of the tags, it's a much improved situation, which really gives them the opportunity to integrate properly into society. These are much more subtle tagging. Importantly, they can rely on them. They have longer battery life, they have less false alarms, and it really gives these people more of a chance to integrate well. We think that one of the things that's going to be important to the trust outlook is actually going to be views around the UK economy and UK politics. And that is despite the fact that actually the portfolio has about 45% of revenue that's generated overseas. But what we see at the moment is that negative view towards the UK economy and politics, you're not helped by very recent volatility in the UK political situation, means that the attitude from actually both international and domestic investors has really been very negative towards UK markets and UK funds. And that's particularly actually hit the small and mid cap space, which is more domestic than, for instance, FTSE 100. And we really see that through some of the discount aspects that we see in our trust and actually more broadly across the sector as well. So while we actually think that many of our companies can be relatively immune to some of these challenges, we do think that it is an overall impact. Now, when we look as well at the outlook, we do think that there's a lot of macro volatility still ongoing, and there are definitely areas which continue to be tough. And I think consumer disposable income aspects are going to be very difficult through winter. And what we see is when we look at a lot of these macro variables, such as interest rates, such as continued high inflation levels, this consumer pressure, also the FX aspects on businesses, which can be both a positive or a negative depending on your exposures. We think the macro continues to actually dominate in many ways, and we look at those aspects really from a company bottom-up level. So how do all of these things influence the potential earnings of our businesses? And we really continue to look and try and identify where we think companies have resilience, have visibility, and have the ability to offset some of these headwinds that they're facing. So when we think about the outlook for markets and the portfolio, I think one of the things that we find really challenging is judging market timing. Now, history would suggest to us that in the UK, markets have turned at the worst point of economic pain. And unfortunately, we aren't there yet. And what's difficult is judging when that point will be. Now, the outlook in terms of the UK economy still looks pretty tough, and I think the recent UK political uncertainty makes it even more challenging. But what's important for us is that actually when that UK market does turn, what we tend to see is that small and mid caps lead that market recovery. And actually, if we look at the disparity in performance in terms of small and mid caps versus FTSE large cap in the year to date, we think that opportunity is definitely there. Now, when we look historically at different bear markets, what it really reminds us of is that when markets turn, they can recover quite quickly. So when we look at the variety of different bear markets that we've seen since the 1980s, the time to reach new market highs in the UK in the FTSE 250 has varied between 3 months and 24 months. Even that 24-month period is not that long for the market to have fully recovered. If we look back to the 1970s, that early period in the 1970s of a bear market, the FTSE All-Share took 33 months to reach a new high. So while timing is definitely something of interest to lots of shareholders and clients, actually, often time in the market is often what matters. And when we look at the moment at the relative valuations of the small and mid-cap space in the UK, there are some really attractive relative valuations in there. So versus large cap, small and mid-cap in the UK traded on around a 30% premium before the Brexit vote. We're now about a 35% discount. So we've seen a real change and some really interesting valuation opportunities. We also don't think you're really paying a lot to have a quality growth portfolio relative to the market at the moment. And if we do go into a tougher economic period, which it definitely feels like we're at the start of, we think that quality aspects, that resilience, that good balance sheet strength, survivability and cash generation could become increasingly important and something that the market's more willing to pay up for.